Hey everybody, welcome back to Markets for Millennials for our weekly market wrap from March 21st to 25. And I have up here the yield chart because obviously the yields have taken off on the 10-year Treasury, as you can see here. We've got a lot of different things going on in markets. We have the continued war between Russia and Ukraine happening right now. We've got the reactions from the West, from NATO countries, from the European Union, sanctions. We have discussions between the Russians and the Saudis and the Chinese and so on of how to price things in rubles or different ways, different monetary solutions to get around the sanctions. We've got markets that have been bouncing this week. And so today, what I'm wondering, the question I'm asking myself is this a dead cat bounce? I've noticed just in my relatively short time investing and watching the markets, people are very quick to start calling bear markets, to start calling crashes. It's almost like people are always looking for reasons to be pessimistic, and so I don't want to come off as an alarmist. When I ask the question, is this a dead cat bounce? I'm really wondering because the markets have been acting in such a way where in spite of everything that's going on geopolitically, in spite of the continuing inflation concerns and the Fed rate hike situation for 2022, the markets are doing reasonably well, all things considered. And so we're starting off here looking at the 10-year Treasury. If we just take a step back and you just kind of look at where we've been since the March 2020 crisis, where we had the big sell down, the big move up, the big move back down, flattened out the beginning of August of 2020 and have been on a grind higher ever since. And we've gone through really two or three, depending on how you look at it, quick moves up, one of which kind of was initiated at the beginning of 2021. We had a really sharp move up from about, what is this, about 97 basis points all the way up to 177. Kind of had a consolidation and a sideways move over the course of the rest of 2021. Had a move up and a kind of a retest of this trend line, this dotted line that I kind of marked, and then we've been on a tear ever since then. And if I just go from the bottom of this move to where we're at today, that's 46% in 18 days. So Treasury yields are moving up, which means that investors are selling their 10-year Treasury bonds. And this is something that we've talked a little bit about in videos past. And so what I thought I'd do is I thought I'd take a look at the yield curve to start out with. And in my newsletter that I post every week on Sundays, and you can subscribe to that in my Twitter bio if you're interested, where I go a little bit more into depth on a lot of these things. And I posted this chart. And what I had been doing was I had been showing the yield curves on, if you're looking from top to bottom, we have the 10s 2s curve, and then we have the 10s 5s curve, and then the 10s 7s curve. And what I thought was interesting was that last week I noted that the 2s 5s curve, the 2 7s curve was inverted, but when I looked at it last week, the 2s 5s curve was not inverted, but obviously you can see that we have crossed below the zero line, and so we are now inverted on the 2s 5s. And then what's interesting is the 10s 2s, so again, from the bottom, 10s 7s, 10s 5s, and then 10s 2s. On the 10s 2s, we are not inverted. However, this can happen relatively quickly, and so this has just one by one the different yield curves, and you can go check out more yield curves if you want to. But the yield curves are essentially continuing to invert. And I actually just saw somebody talk about this recently. So what I'm actually going to do is I'm going to go US 30-year minus US 05-year, and we're going to look at the 30s 5s curve. And what's really interesting here is you can see that we are just about at that zero line on the 30s and 5s, which I suppose is not all that surprising. So I think what I'm going to do here is I'm going to just really quickly mark the zero line. We'll make it gold because that's the golden line. So we're really close to that in the 30s, 5s yield curve, which some people also look at. So I think that is something to note. But anyway, going back to the main curves that I have been watching, I'm wondering if over the next week or two, if we continue to get yields bid, particularly of the 10-year, are we going to see yields continue to rise because people are selling those 10 years and buying those 2 years? So why don't we just, while we're together here on this video, we'll take a look at the 2-year yield. And it is basically going parabolic. And so that's obviously not a good thing. So actually, I think I misspoke. They're selling the 2-year off even more. So we're getting to a situation where we're not too far away from the yield curve suggesting a recession, which it has done. My chart's all messed up now, which it has done for the last 50 years. Every time it's gone below zero, every time this curve that I was showing you, this top one, every time it goes below that zero line, it signals a recession. Now, to back to my original question, is this a dead cat bounce? I'm going to pull up this chart. This is the S&P 500 futures at the top, the NASDAQ futures second in the orange, the Dow futures in blue third, and the Russell futures fourth in the yellow. And this is the week, the performance this week, not the weekly chart. Please don't be confused. It's not the weekly chart. It's just the chart of price action during this week from March 21st to 25th. And you can actually see that particularly on the S&P and on the NASDAQ, you can actually see, if you look really closely, you can see the lines, the price lines. And we're at the top edge. Like most of the price action is under the current price line on the NASDAQ, on the S&P, and on the Dow. A little bit different on the Russell. It's a little bit more even. But all that to say, if we take a look at each chart, in the bigger chart, I should say, you can see that we've just continued our bounce, although it looks like we're leveling off, except we did close fairly strongly today on the S&P. Again, like I don't want to, I'm not trying to act like a bear, and I'm not trying to say that we're just going to roll over and that this is just a dead cat bounce, because I do think it was good that we got that this rally that we were on, as I mentioned last week, got over this swing high that I marked right here with this green line that I've kind of been indicating on these green lines. It was good that we got over it, but the problem is that this is really only the second meaningful bounce that we've gotten on this sell down. The first one was right here, the end of January and into early February, and we have not made a higher high than that yet. So that's definitely something that I'm watching for. So I want to see if our rally takes us over that line. And then on the NASDAQ, I would say where this red line is, we got to get over that. And then on the Dow, our line is a little bit more steep. It's up here. And then the Russell is really interesting as we look closely here. You can see I had this dotted line as kind of like the main trend line of repair. And then I had what was kind of the bottom support of this price move over here in November, December 2021. And then we were consolidating, and I made a note to say that it was interesting that price was not making lower lows. It was actually consolidating with lower highs and higher lows into this sort of sideways triangle kind of wedge looking thing. And what's really interesting is at this, and I talked about this last week in the weekly update, on this confluence where we've got these lines that are crossing each other. It looks like it's holding there pretty well. And so what I'm going to be watching for is, are we going to get follow through to get above this higher high, or this high, which would also coincide with this kind of swing high, if you want to call it a swing high, from early February. So that would be something to watch. And then of course we got to get above this level on the Russell. And And so that's going to be something that I'm watching for to see if we can. And I don't anticipate that, especially this second level on the Russell, will get beaten out over the next week. It would take a couple of weeks, I think, for that to take place. But anything can happen. So even though there has been some good price action over the last week or two on equities, we're not out of the woods yet. And I said it last week, we still have a lot to repair. Now, one thing that I heard people talking about, and I'm going to look at here with you live right now, is I'm going to go down and I'm going to, actually, let me take the closing high. I'll be a little bit more objective here. Take the closing high to the closing low of this move, and we are actually on the S&P topping at the 618 retrace Fibonacci level, which is historically is a pretty important level, and is often the level that holds, whether it be on a move up and then a kind of sell-off. A lot of times we bounce there. Sorry about that. Or if we've sold down, then sometimes we find that 618 level as resistance. And so I don't think it's a coincidence that that level is coming in right around the same place that this, it's just a little bit below where I put my line here on the S&P. So it's going to be something that I'm watching for. And then if we do that same thing on the NASDAQ, again, taking the closing high and going down to the closing low, we're a bit lower. We're at the 5 level. So, but again, you can see that the really important resistance level that I was talking about, that red line that I showed you, is coming in really close to that 618 level. And then looking at the Dow, we're going to do the same thing. And right now we're resting just above the 0.5 level. And in this case, I have one red line horizontal resistance that I put right around the 618. But then this really, really important level that I was talking about is actually at the 786 level. So that's going to be something to watch as well. And just since I'm doing this already, I'll take a look at the Russell doing this. We've got way more levels to go on the Russell. But again, look at that. You can just see that the most important level to get over that I mentioned is really close to this 618 level. So something to be aware of. We'll take a look at the dollar index. And one thing that I have been watching on the dollar, I had been watching the euro. And I actually do think, let's actually pull up the euro US dollar really quick, because we had gotten some strength last week in the euro, and then I'm trying to remember if I talked about this. I don't remember if I talked about this in the video or in my newsletter, but I actually expect euro weakness to resume. In fact, if you look at other euro charts, like if we look at the euro Australian dollar, you can see we actually, after the bounce, we've made a lower low. I think it's really interesting too, considering I think there's a lot of factors that are going into why specifically the euro is doing so poorly against both the Australian dollar and the New Zealand dollar. If you look, again, making lower closing lows on these daily charts. And so again, like, I think the euro is bound to be weak for a prolonged period of time. But I also think that it has a lot to do with the risk on, risk off situation. So let me pull up my risk off or risk on, risk off charts. And this is looking at risk on, risk off since just in the month of March over the last, I would say, 2 weeks or so. And you can see, again, the price lines are at the top of the price action. And so we continue to have, in terms of risk on, risk off pairs, in the currency markets, they continue to show that we are more risk on than we are risk off. And it's really interesting. And you have to take that into consideration, as you also take into consideration that the Australian dollar and the New Zealand dollar are also commodity currencies. And so when you take a look at, I totally messed this up, sorry. So when you look at gold, which after having a couple of days of a break is continuing to the upside, but also we didn't make a higher wick high today, so it's kind of interesting to see that. Gold has, after selling down, recovered a little bit. You're also seeing let's see, this is WTI oil. You've also seen a little bit of a recovery in oil, although interestingly, I'm just seeing this now as we've closed on Friday. But this actually looks like kind of like a rollover. It doesn't mean that we won't find support here at this support line, trend line that I'm looking at. But I do think it's interesting. I can't be too sure, but this kind of looks like how can I say, like the Wall Street cheat sheet, like almost like a blow off top, because you see on this Fibonacci retrace, you see that we bounce up to the 618 after having a huge rise in price. And so I'm just wondering if, again, my personal conviction is that oil will be on its way up, and what we might actually get is a more gradual grind up. But I think in this case, because we had these price moves with the war premium with Ukraine and Russia, that whole situation, because the war premium was pricing in, I think we had to blow some of that off. We have to sell some of that back. And so I could totally see us coming back down to support to this support level, which right now is, if we kind of consolidate down steadily, we could see us coming back down to the 100 to 105 level before touching again on this support line. And if this support line holds and we resume off, then I think, like I said, my conviction about where oil is going on that kind of slow grind up, I think it will continue to play out. So having said all of that, let's see, where was I? See, I have to fix my chart now. Here we go. So yeah, having said all of that, going back to the currency markets, it's just interesting to me to note that this whole thing is going on. So the other thing, so I had been watching the euro for some time. And again, the euro is showing weakness, particularly against these commodity risk-on currencies. And what has been getting a lot of action lately is the Japanese yen. In fact, if I come back, let me go to my U.S. dollar Japanese yen chart really quick. We've been seeing the yen get killed. And so as soon as this broke out, and some of you guys who have been following me, I had this kind of trend line right there, and then sort of like this wedge. And as soon as it broke out, I converted all my FX charts, or this four-way FX chart, to track the US dollar versus the Japanese yen, the euro versus the Japanese yen, the British pound versus the Japanese yen, and the Australian dollar versus the Japanese yen. And if I just pull this back, you can just see the further back that I go. In fact, if I change this from a 5-minute chart to a 15-minute chart, it'll let me zoom out even further. And you just see that for basically the whole month of March, the yen has, ever since maybe about March 4th, the yen has been getting killed versus all of the major currencies. And obviously monetary policy has a lot to do with it. The Japanese central bank is, basically they're just printing to oblivion. They've already got, I'm pretty sure, I don't remember, they've got yield curve control already instituted. And so all the currencies are moving pretty heavily against the Japanese yen. So I think that's really interesting, and I think that affects, typically if say this bottom one, the Australian dollar, if it's performing well against the Japanese yen, it typically means risk on. But because the yen is basically being destroyed by every currency, then that makes me question whether or not we're truly risk on. So I guess what I'm saying is the currency markets are telling me something different than what the yield curve and the yield situation in general are telling me. To go back again to the yields. Wow, I think I took a really huge sidetrack there. But anyway, on the DXY, we've had, again, I think part of the reason the DXY has been strong, but not as strong as it was in this rise, is because the euro has strengthened a bit, but then the Japanese yen has been being destroyed by the dollar. So I think that's part of the reason why you're getting some of this price action. But as you can see, we're consolidating now on the dollar in this range between this ascending trend line, which was resistance and is now support, and this descending dotted trend line that I have here, which if I pull this back, you can actually see that this goes back to this top in 2017, and then connecting again right following the March crisis. We saw it kind of being the non-black swan event resistance level. And so I think that level has been pretty important, and the market is showing you that level is important as well. So to take a quick look at gold, you can see here gold, it looks like it's kind of getting stuck in this range. Gold's been a little disappointing just because in this environment you would expect, especially with the war situation, that gold would have actually probably taken out its all-time high, but it hasn't in terms of the wicks at least. And then silver, there we go, silver. Silver's rise wasn't as parabolic, and its recovery also wasn't as harsh to the downside. But we're also, again, in this no man's land between 24.76 and 25.75. So basically $1 worth of price action space is kind of where we're stuck between at this particular point. And that level, as you can see, it's interesting to see the current resistance level was support at various times throughout the last 2 years. And then the lower trend line, which is the support horizontal trend line, has been resistance actually back in 2020 and then across the later half of 2022 or 2021. And so I think that is pretty significant. And so all that is to say that I think the markets are mixed. I don't think that they're confirming each other. I don't think that the markets are telling the same story. You can see here as we go to the volatility index, got to change really quick this color because now we've crossed below, what is that? We've crossed below this 23.45 and we're closing just above the 20 level on the VIX. And so volatility is getting squashed down. So I'll be watching to see if we make a lower low than right here, which is basically at 20. I'll be watching that to just see what's going on there. But again, like I talked about this previously, if you were to draw a trend line like that, we had a breakdown, retest, and resumption down. And so volatility is being smashed down. So to me, in spite of the situation with the rate hikes, it seems to me that the markets are more likely pricing in that we already had a bottom. That the markets over the last, if I pull up, let me pull up the 4 hour here. Let's do it this way. No, that's not enough. We'll do the daily on this chart. Oh wow, that is a lot actually. We'll do it this way. Sorry about that, you guys. So it just seems to me that after the sell down from the tops of the equity markets, it's almost like the markets have now priced in prior to the rate hikes, priced in that the rate hikes were happening, because basically ever since the the Tuesday of the Fed meeting, right? That's the day before the rate hikes were officially announced. That was when we hit the bottom. That was when, or I should say, we confirmed the bottom and didn't make a lower low except for on the NASDAQ. And we've been up ever since then. So this is either a dead cat bounce, as the title of this video is positing, or the markets really are about to go totally risk on, and we're going to see volatility being suppressed, and we're just going to continue to move to the upside and potentially back to all-time highs on the indices. And I thought I would also mention here, as I go back to the yield curve charts, the yield curve inverting doesn't mean that the recession is tomorrow. The yield curve actually inverted in 2019, I believe in August or September of 2019, and it wasn't until almost 6 months later that the COVID crisis caused the recession. That took 6 months. So it doesn't always it takes time usually for these things to transpire. So we could totally be in a situation where if we let me really quick go back to the my S&P chart here. If you go back, the yield curve inverted somewhere around here on my S&P chart right here. And so if you just kind of go from like the center point there, we went up 13% before we had the crash and the recession. And so you guys got to know, we could see price recover and make all-time highs before we go into any sort of actual recession. And so I think that that's something to watch for. That's why I don't think it's a good idea to play the short side really long. I think that anybody who took short positions around here thinking we were going down, because I saw people saying, oh, we're going to go 20% down, 25% down, 30% down, and we still could. But anybody who took short positions, if they didn't place their stop losses in the proper spot, then they're getting destroyed right now. So you just have to continue to be really careful. And so that's what I'm doing. That's why I am staying mostly on the sidelines and trying to not take any new trades unless opportunities present themselves. And I actually talk about some of those stock opportunities, particularly in my newsletter. You can find that in my Twitter bio at Mr. J. Thomason. And so that's where I'm going to leave you guys today. A lot of things to think about. And just a lot of uncertainty out there. But like I said, at the end of the day, we have to face the question of, is this just a dead cat bounce, or are we about to go on a new run that will take us to all-time highs or beyond? So thank you for watching. I hope that you were able to get a good view of the markets. Go ahead and like and subscribe if you found this interesting. Share it with somebody who you think would find it helpful. And I will see you guys next time. Hope you have a great weekend.